Hello everyone. A multitude of significant events have transpired across the globe recently, and today on our channel, we delve into the intricate details of economics and politics shaping our world. We'll explore the complex dynamics and provide in-depth analysis. Make sure to subscribe to our channel and hit the like button. Your support is incredibly important for helping us grow and continue bringing you valuable content. We'd also love to hear from you, so please drop a comment below, letting us know where you're tuning in from. Stay with us, because at the end of this video, we'll be summarizing the key takeaways and offering our concluding thoughts on these developments. What precise actions did China undertake that resulted in Intel forfeiting $100 billion within a mere 48 hours? On April 12, 2025, a move by China precipitated a staggering $100 billion loss for Intel in just 2 days. The corporation's stock value tumbled by 18.3%, dealing a substantial blow as this market constitutes 27% of Intel's total revenue. How might this development reshape the technology sector? China inflicted a severe setback upon Intel. On that significant date, April 12, 2025, the Chinese government prohibited its agencies and major corporations from procuring chips manufactured by prominent U.S. companies, including Intel, AMD, and Micron. This was far from a spontaneous occurrence. It represented a meticulously calculated maneuver. The immediate consequence? Intel shed $100 billion in market capitalization within 48 hours. Please stick around until the end of the video, as we will be providing comprehensive conclusions on these critical events. So, what unfolded subsequently? Intel's stock plummeted by 18.3%, erasing $100 billion from its market valuation. China represents a vital market, accounting for 27% of Intel's earnings, which translated to $22 billion in 2024. This heavy reliance rendered Intel particularly susceptible to a strategic strike from China. The repercussions extended beyond Intel, rippling through the entire United States technology landscape. Intel was not the sole entity impacted. The sharp decline in Intel's stock dragged down key semiconductor indices like SOX and SMH, which fell by 4.2% and 2% respectively. This underscores Intel's overdependence on the Chinese market. When targeted, the ripple effects destabilized the broader U.S. tech industry. These consequences are not confined to Intel alone, but propagate to other technology firms, amplifying concerns regarding the stability of the global supply chain. Should the U.S. semiconductor sector fail to diversify its markets swiftly, it risks facing a protracted period of crisis. China harbors ambitions to fundamentally alter the global technology landscape. Beijing hasn't merely severed connections with Intel. The nation has established a strategic objective to eliminate U.S.-manufactured chips from its public infrastructure and energy systems by the year 2027. Industry experts forecast that this initiative could potentially eradicate $350 billion in annual revenue for American chip manufacturers by that target date. Attaining complete technological self-sufficiency is a formidable challenge. Nevertheless, China's strategy is advancing rapidly, fueled by substantial investments and determined efforts to cultivate indigenous chip technology. The global tech industry might soon undergo a profound transformation. If China achieves its goals, not only the United States but also other nations reliant on U.S. chips will encounter significant disruptions in their supply chains and challenges to their technological sovereignty on a global scale. Huawei emerges as the most significant contender challenging U.S. dominance in this arena. The company has remarkably succeeded in producing 5-nanometer chips without resorting to extreme ultraviolet (EUV) lithography technology, a feat previously deemed unattainable by American experts. This achievement demonstrates China's capacity to independently manufacture advanced chips, circumventing the need for U.S. assistance. How could this development revolutionize the industry? If Huawei can accomplish this for smartphones, could it replicate this success for servers, cloud computing infrastructure, or artificial intelligence hardware? This is the pivotal question preoccupying tech analysts worldwide. With the demonstrated capability to independently produce cutting-edge chips, Huawei is not merely competing directly with giants like Intel, but is also influencing the global pricing and accessibility of high-technology products. If Huawei persists in its strong developmental trajectory in this domain, consumers globally might observe a major shift in the tech market, characterized by the increasing popularity and competitive pricing of Chinese products, thereby challenging the established positions of U.S. technology titans. The impact of these shifts is already being felt by American consumers. Major computer manufacturers like HP and Dell have declared price increases ranging from 12 to 17% for machines utilizing Intel processors. These supply chain disturbances are anticipated to inflate the costs of various electronic goods, directly affecting consumer budgets. Consequently, individuals will likely need to allocate more funds for the products they routinely purchase. This extends beyond computers to encompass other electronic devices such as smartphones, servers, and advanced tech items, all of which are expected to experience similar price escalations. This trend contributes to a higher cost of living for American citizens, making everyday necessities more burdensome. Price hikes and product shortages loom as the tangible reality confronting American consumers in the foreseeable future. China has also severed ties with ASML and TSMC, pillars of the Western chip manufacturing ecosystem. Is the Western chip industry facing an impending collapse? China startled the global community by ceasing cooperation with ASML, a critical supplier of lithography equipment, and TSMC, the world's largest contract chip manufacturer. Between 2022 and 2024, China channeled an impressive $75 billion into its semiconductor sector. This massive investment attracted over 50,000 skilled engineers and was coupled with the imposition of an 84% tariff on U.S. goods. Does this signify the decline of Western supremacy in the chip industry? China didn't merely halt purchases of equipment from ASML and TSMC, it decisively opted to sever all cooperative ties entirely. This represents a potent retaliation against pressures exerted by the U.S. and its Western allies. In 2025, the Netherlands, prompted by the U.S. within 72 hours, suspended the delivery of essential deep ultraviolet (DUV) lithography machines to China. In response, China resolved to completely cut off relations with both ASML and TSMC. This action is not a fleeting adjustment, but a component of a long-range strategy designed for China to gain control over the future trajectory of its semiconductor industry. From the moment the U.S. and Western nations levied sanctions, China refused to yield. Instead, these measures catalyzed the acceleration of China's domestic semiconductor industry development. From 2022 to 2024, China invested upwards of $75 billion in research and development, aiming not just for self-sufficiency in chip supply, but for the creation of a wholly independent chip ecosystem. Over 50,000 engineers, including talent drawn from leading firms like Huawei, have bolstered China's chip research workforce. What is particularly striking is that China is not merely weathering the sanctions, it is retaliating vigorously. In 2025, China levied an 84% tariff on U.S. exports, a direct counterstrike against prior American tariffs. This maneuver has sent tremors through the global economy, intensifying worries about escalating tensions in international economic affairs. This shift affects not only China, but also disrupts the entire global tech industry. Western companies, particularly ASML, are confronting substantial repercussions as their revenue streams from China have plummeted. However, this impact transcends the semiconductor industry alone. China is concurrently pursuing a wider financial strategy, formulating plans to exert influence over global financial markets. It's evident that this strategic reorientation is not merely unsettling the tech sector, but is also generating considerable turbulence within international financial markets. China hasn't simply shielded itself from sanctions. It is forging a new wave, establishing itself as a formidable competitive entity within the global tech landscape. Can Western nations adapt to this evolving dynamic? A sudden financial maneuver. China mandates a freeze on all investments directed towards the United States. This quiet decree carries devastating potential, possibly thrusting the U.S. economy into an unparalleled financial crisis. Over just a few years, the trajectory of Chinese investment in the U.S. has undergone a shocking reversal. Plummeting from a peak of $46 billion in 2016, China's investment dropped to a mere $2.3 billion by 2024. Now, with Beijing enacting a complete freeze on these investments, the figure approaches absolute zero. A significant question emerges. Why has China opted to entirely halt this capital flow? The explanation is multifaceted. China isn't merely halting its investments. It is executing a long-term strategic plan. This involves redirecting capital away from the U.S. and channeling it into regions deemed more politically and economically advantageous. This isn't an impulsive shift. It's a calculated strategic move. Simultaneously, U.S. businesses are grappling with a financial nightmare. In a single night, companies like Hartwell Tech witnessed losses of $180 million. To remain solvent, they've been compelled to secure emergency loans bearing interest rates as high as 11.3%, nearly double the standard rate. This predicament doesn't just plunge them into a precarious financial state. It could potentially push these companies towards bankruptcy if the situation endures. High interest rates aren't solely a burden for large corporations. They directly impact American consumers as well. These loans will inevitably translate into increased prices for goods and services, requiring households to pay more. Ultimately, this is not just affecting companies, but is also directly menacing consumers. Tariffs on goods imported from China are causing consumer prices to soar. On average, each U.S. household will need to spend an extra $1,950 annually just to cover basic consumption needs. At the same time, corporate profits within the S&P 500 index are plummeting, while inflation holds steady at a high 3.6%. This indicates a decline in the quality of life for the populace, with wages stagnating while prices persistently climb. Major projects once viewed as indicators of U.S. economic recovery are being deferred or scrapped. For instance, Intel's chip factories and initiatives related to batteries and robotics in Ohio have been put on hold due to the cessation of funding from China. Furthermore, 62% of U.S. manufacturers report facing critical financial shortages that impede their expansion plans. This isn't merely impacting large enterprises. It's also jeopardizing millions of jobs across the U.S. as domestic manufacturing projects are delayed or canceled, inflicting significant losses on the economy. The situation isn't static. Capital is rapidly exiting the U.S. market. An astounding $120 billion has been withdrawn from U.S. stock ETFs within just 90 days. This isn't a temporary fluctuation, but a clear indication of a capital exodus. Investors are increasingly apprehensive about the stability and long-term outlook of the U.S. economy, especially as other nations pursue opportunities in alternative markets. Countries that were previously key investment partners, like Norway and Japan, are now scaling back their investments in the U.S. market. This trend not only leaves the U.S. economy facing a capital deficit, but also markedly diminishes the nation's financial influence globally, impairing its capacity to sustain global strength as the world's largest economy. The U.S. is currently confronting a debt wall amounting to $4.1 trillion from businesses set to mature by 2026. In the context of diminishing foreign capital inflows, U.S. companies are increasingly dependent on junk bonds, with yields reaching as high as 9.6%, double the rate observed in 2022. This signals an imminent debt crisis, suggesting U.S. businesses may face steeper borrowing costs and substantial hurdles in maintaining their operations. China has canceled significant Boeing orders. Could this be the blow that cripples American aviation? 9% of Boeing's stock value has evaporated. $12 billion in projected annual revenue is now seriously threatened. Over 1,200 Boeing aircraft are currently grounded, awaiting potential buyers. China has suspended all Boeing deliveries. No negotiations, no prior warning. A single decision, and the markets were instantly destabilized. Within days of this announcement, Boeing shares dropped between 9 to 10%. This wasn't merely a numerical fluctuation. It was a potent market signal. Boeing could potentially lose up to $40 billion in market value over the next 6 to 12 months if the situation remains unchanged. If this trend persists, the losses could escalate to $150 billion within the next decade. Why is this shockwave so impactful? Aviation constitutes one of America's fundamental export industries, playing a crucial role in mitigating the current account deficit. The annual value of U.S. aviation exports approximates $130 to $140 billion, with China accounting for 15 to 18% of that total. Losing this substantial market could cost the U.S. billions annually. The supply chain breakdown also puts thousands of jobs at risk. It's not just Boeing feeling the impact. Over 30,000 employees work directly within Boeing's commercial aircraft division, supported by thousands of auxiliary companies spanning all 50 U.S. states. This intricate network involves over 11,000 suppliers nationwide. From titanium sourced in Utah and avionics produced in Oregon to seat manufacturers based in Texas, every single component represents local employment, families, and livelihoods. If these crucial orders vanish, suppliers might be compelled to cut between 5,000 and 10,000 jobs in 2025 alone. That figure could climb even higher should the situation extend into 2026. Consumers are poised to feel the direct consequences. The aircraft shortage isn't merely a corporate predicament. Consumers will likely be the first to experience the fallout. Air ticket prices could surge. International routes, particularly those connecting the U.S. and Asia, might face cancellations or significant delays due to the unavailability of replacement aircraft. Popular models like the 737 MAX, 777, and 787 are extensively utilized by Chinese airlines. Transitioning to Airbus requires months of retraining, substantial infrastructure modifications, and millions in additional expenditures. Is Boeing paying the price for a protracted conflict? Boeing had previously projected $9 to $10 billion in revenue from China for 2025. Now that figure is rapidly approaching zero. Analysts are sounding the alarm. If China fully pivots towards Airbus and its domestic manufacturer, Comac, Boeing could find itself excluded from the world's second-largest aviation market, not just for a year, but potentially indefinitely. Some industry insiders express concern that without immediate strategic adjustments, Boeing might lose access to the Chinese market for the next 30 years. This transcends a simple business disagreement. It serves as a case study illustrating how geopolitical forces can reshape markets, redefine international partnerships, and fundamentally restructure global supply chains. With over $150 billion in contracts jeopardized, $12 billion in annual revenue disappearing, and thousands of jobs hanging in the balance, American aviation now confronts a critical test of its resilience. One delayed shipment of a single crucial mineral highlights a major vulnerability. Is the rare earth crisis boxing America into a corner? A $2.3 billion U.S. satellite launch was postponed, not due to a technical malfunction, but because a critical shipment of neodymium failed to arrive from China. Neodymium, though small, is an essential component. It forms the core of guidance systems in satellites, missiles, and even everyday devices like your next iPhone. The issue revolves around rare earth elements, the hidden pressure point capable of repricing the global economy. China currently dominates 89% of the global rare earth refining capacity. This control isn't just about mining, it's about the sophisticated infrastructure required for processing. Meanwhile, the United States, despite possessing resources like the Mountain Pass mine in California, remains dependent on shipping its concentrates to China for refinement. In essence, the U.S. isn't lacking the raw minerals themselves, but the technological chains to process them effectively. Once the ban was implemented, global supply chains fractured almost instantly. According to the U.S. Department of Energy, over 90% of the magnets used in American wind turbines and electric vehicle motors depend on Chinese refining capabilities. The immediate result? General Motors issued a warning. If the neodymium supply is disrupted, EV production could face delays of up to 9 months. Prices are escalating, inflation is persistent, and consumers are bearing the cost. Between January and April of 2025, the price of magnet materials, primarily sourced from rare earths, surged by 41%. Consumers are directly experiencing this impact, with electric vehicle prices potentially increasing by $1,000 to $5,000 per unit. And the impact isn't limited to automobiles. Renewable energy equipment, smartphones, computers, virtually anything incorporating motors or complex circuit boards is affected. Households are consequently paying higher prices for products once deemed essential. This situation isn't static. National defense capabilities and the risk of losing strategic control are major concerns. Approximately 1/3 of U.S. missile guidance systems rely on dysprosium refined in China. This shortage isn't merely a matter of cost. It's fundamentally about timing and precision. A report from the Congressional Research Service highlights that without a stable alternative source, the accuracy and range of missile systems could significantly degrade within 24 months. Clean energy initiatives are also not insulated from these effects. A January 2025 report from the International Energy Agency, IEA, cautioned that rare earth shortages could inflate the installation costs of offshore wind projects by 22% within 18 months. What does this imply? It means that green energy, anticipated to become more affordable, will instead become costlier and slower to implement. Concurrently, China is discreetly expanding its investments in mining operations across Africa and Southeast Asia, securing global supply lines for the upcoming 2 decades, stretching from Namibia to Indonesia. The IEA estimates that if the current ban persists for 12 months, global EV output could decline by 6.2 million units by 2027. This figure represents a potential setback for the entire decarbonization movement. For American consumers, the outlook is clear: higher prices, fewer available options, and extended waiting periods. The U.S. is implementing response measures, albeit slowly but necessarily. The U.S. Department of Defense has allocated $1.22 billion in contracts with domestic and Australian firms to establish closed-loop supply chains. However, the Government Accountability Office, GAO, has warned that the environmental permitting process within the U.S. alone typically spans 7 to 10 years before new projects can become operational. Even though Congress approved a $3.4 billion support package and sanctioned 5 strategic stockpile sites, these measures cannot fully substitute for the refining expertise China has cultivated over the past 25 years. The 47th president recently announced a potential 50% tariff on $700 billion worth of Chinese goods. Yet the fundamental issue isn't merely about who imposes taxes on whom. It's about who controls the essential supply chains. When a single nation can interrupt the flow of a critical material, grounding satellites, halting factory production, and compelling consumers to pay inflated prices, the established balance of power fundamentally shifts. The U.S. auto industry faces a staggering loss of $219.5 billion. Simultaneously, the European Union and China are turning the tables with their own set of sanctions. What does the future hold? The U.S. auto industry has seen car prices escalate by $15,000 to $30,000 in just 1 month. Job losses have been significant, with 200,000 positions eliminated as the EU and China implement stringent sanctions. Germany, a leading force in the EU, has suspended the certification process for U.S. electric vehicles. This action means that popular electric car models such as Tesla, Ford, and GM can no longer be sold within the EU, a massive market comprising over 440 million consumers. This represents a substantial blow to U.S. car manufacturers, directly impacting their profitability and potential for industry expansion. Additionally, France has introduced a carbon tax targeting vehicles weighing over 1,814 kilograms and those equipped with engines exceeding 300 horsepower. This policy effectively prevents vehicles like the Ford F-Series, Chevrolet Tahoe, and Hummer EV from being sold in France. These combined measures not only inflict financial damage, but also position U.S. car manufacturers within an increasingly restrictive regulatory landscape across major European markets. The repercussions extend to the U.S.-Canada trade relationship and exacerbate the domestic job crisis. The situation is not confined to Europe. Canada has aligned itself with the EU by signing the Green Technology Access Partnership Agreement. This accord makes it more challenging for American cars to be exported to Canada, thereby shrinking market opportunities in this vital neighboring nation. This development not only jeopardizes the U.S. auto industry, but also diminishes cooperation between the two countries across numerous sectors. The most alarming aspect is the speed at which these changes are unfolding. In a mere 3 weeks, the U.S. auto industry has forfeited 200,000 jobs. Workers in automotive manufacturing plants, technicians, and truck drivers are confronting widespread unemployment, fueling a significant job crisis. States heavily reliant on the auto industry, such as Michigan, Ohio, and Kentucky, have been severely affected by this downturn. This decline impacts not just automotive workers, but also reverberates through related industries, leading to production halts and diminished incomes for countless families. The broader impact on the U.S. economy and its consumers is profound. The U.S. auto sector is not merely contending with market share erosion, but is also facing direct consequences on car prices and the living standards of its citizens. Car prices have surged by $15,000 to $30,000, driven by the imposed tax measures and sanctions from European nations. For instance, Tesla has been forced to increase its prices by $8,000 in markets like Denmark and France, rendering American vehicles less competitive. Unemployment rates are climbing, with over 200,000 workers losing their jobs, precipitating a severe job crisis in auto-dependent regions like Michigan, Ohio, and Kentucky. Concurrently, living standards are markedly declining as consumer spending has fallen by 3 to 5% due to inflation and job losses. This constitutes a major jolt to the U.S. economy and particularly affects workers reliant on the automotive sector. Projections for the future of the U.S. auto industry appear grim. Looking ahead, the industry is bracing for a significant contraction. Over the next 3 to 5 years, the sector could potentially lose 5 to 10% of its global market share if it cannot successfully navigate and adapt to evolving international standards and regulations. Europe and Asia continue to bolster their positions within the auto industry, while the U.S. grapples with adjusting its regulations concerning technology and environmental protection. Specifically, confidence in U.S. manufacturing regulations and standards is waning. International partners are scaling back cooperation and gravitating towards nations with more robust and sustainable standards. This trend risks isolating the U.S. economy in the near future. Other countries, especially within Europe and Asia, are poised to strengthen their standing and intensify competition, further eroding the U.S. position on the international stage. China has imposed tariffs on American products, focusing particularly on automobiles, machinery, and semiconductor components. Concurrently, its holdings of U.S. Treasury debt have been reduced to $668 billion. This maneuver has triggered shockwaves across the global economy. On April 11, 2025, China enacted a bold strategy by imposing a 125% tariff on key U.S. exports. The primary targets include cars, technology machinery, and semiconductor components, industries that collectively contributed over $36 billion to the U.S. economy in the previous year. This is a calculated strategic move by China, aimed not just at revenue collection through taxes, but fundamentally at reducing its reliance on the U.S. within the framework of international trade. The ramifications of this tariff assault are undeniable. U.S. companies now confront elevated production costs, and consumers will inevitably face the consequences through increased prices for essential items like cars, computers, and electronics. One of China's central strategies involves diminishing its dependence on the U.S. dollar, particularly within international financial dealings. China has significantly decreased its holdings of U.S. Treasury debt, now amounting to just $668 billion, the lowest point in 15 years. This action signals China's diminishing confidence in the dollar and its intent to move away from it. China is also progressively adopting the yuan and the euro for international trade, especially in significant trade agreements with nations such as Saudi Arabia, France, and Brazil. This transition not only impacts the U.S. directly, but also catalyzes shifts within global financial supply chains. As this trend gains momentum, the U.S. dollar could encounter heightened competition from alternative currencies. This might elevate the costs associated with international transactions, and introduce financial instability for U.S. corporations and consumers. This strategic shift is not an isolated event, but rather the culmination of numerous incremental steps taken over time. This change is not merely a consequence of a sudden economic shock, but is unfolding through thousands of deliberate smaller actions. China is not simply reacting to external pressures, it is actively constructing an independent financial ecosystem. This move is not solely economic, it carries significant political weight, demonstrating China's resolve to lessen its dependence on the U.S. financial system and pivot towards a multipolar financial architecture. Countries like Brazil, France, and Saudi Arabia are investigating alternative payment systems for transactions, thereby circumventing the necessity of the U.S. dollar. While this shift primarily affects the U.S., it also generates ripples across global financial supply chains. Should this pattern persist, the dollar may face fierce competition from other currencies, potentially increasing the cost of international transactions and fostering financial volatility for U.S. companies and consumers. This shift is not emerging from a single major event, but is the result of countless quiet, strategic adjustments. China is not merely pulling away from the U.S. dollar, it is methodically building its own independent financial infrastructure. These actions could potentially weaken the U.S. dollar's role in international trade. The global economy might be transitioning away from a unipolar financial system dominated by the U.S. towards one characterized by new financial centers, with China and the yuan playing increasingly prominent roles. This presents a formidable challenge for U.S. leaders tasked with preserving the nation's economic strength while China continues to consolidate its position on the world stage. The impact of these tariffs on the U.S. economy is stark. While a full-scale crisis has not yet materialized, the U.S. stock market is exhibiting signs of significant strain. The S&P 500 index has declined by 3.5%, and the Dow Jones has experienced notable drops in recent days. According to analysts at Goldman Sachs, the probability of a recession is increasing, now estimated at a 45% likelihood. This growing risk is primarily attributed to a decrease in exports and heightened market volatility. The agricultural sector, particularly producers of soybeans and grains, has been severely impacted. Although the reported 4.3% decline in exports awaits final confirmation, it is evident that trade disruptions are exerting immense pressure on American farmers. China's reduced imports from the U.S. are affecting domestic food prices, further increasing the cost of living for American consumers, especially impacting low-income households. People are forced to spend more on food, while farmers grapple with the loss of significant markets. Simultaneously, major U.S. companies such as Tesla are maintaining export activities to China, but are confronted with escalating costs due to tariffs and disruptions in the supply chain. This situation is expected to lead to diminished production and supply capacity, making it more difficult for workers and consumers to access affordable technology products. In conclusion, the events surrounding China's strategic economic maneuvers, particularly the ban on U.S. chip purchases impacting Intel, the halt of Boeing orders, the imposition of tariffs, the reduction of U.S. debt holdings, and the potential leveraging of rare earth mineral supplies, collectively paint a picture of a significant geopolitical and economic shift. These actions underscore China's determined push towards technological self-sufficiency and its strategy to reduce reliance on the U.S. dollar and Western technology, potentially reshaping global supply chains and altering the balance of economic power. The immediate financial losses for major U.S. corporations like Intel and Boeing, coupled with the ripple effects across the semiconductor and aviation industries and their extensive supplier networks, highlight the vulnerabilities of deep economic interdependence. Furthermore, the impact extends directly to American consumers through anticipated price hikes for electronics, vehicles, and even basic goods, alongside potential job losses in affected sectors and a rising cost of living exacerbated by inflation and strained supply lines. The potential weaponization of rare earth mineral exports represents a critical strategic threat, impacting not only commercial industries like renewable energy and electric vehicles, but also vital national defense systems reliant on these materials. China's move away from the U.S. dollar and treasury holdings, favoring the yuan and alternative financial systems, challenges the dollar's long-standing dominance in global trade and finance, signaling a potential transition towards a more multipolar economic world order. While the U.S. is implementing countermeasures, the long-term effectiveness remains uncertain given the complexities of global supply chains, the lengthy timelines for developing domestic alternatives, especially in refining and high-tech manufacturing, and the intricate web of international trade relationships. This evolving landscape presents a daunting challenge for the U.S. economy, demanding strategic adaptation, diversification, and potentially a re-evaluation of its global economic partnerships and dependencies. The coming years will be crucial in determining whether the U.S. can navigate these pressures and maintain its economic standing, or if these developments mark the beginning of a more profound and lasting shift in the global economic hierarchy. Thank you for watching. Remember to like, subscribe, and comment below. Your engagement helps our channel immensely.